If you want to be a successful stock market trader, you need to have a set of stringent rules in place that you abide by. Stick around to see my top 5 golden rules for stock market trading. How's it going, guys? Ryan here, and welcome to another episode of Stock Market Basics, where I share with you my top 5 golden rules for successful stock market trading. Now, rules are really important and you need to abide by them if you want to be successful, especially in the long term. With good rules in place, you mitigate your losses and increase your chances of success, and as a result, your profits overall. So you really need to make sure you've got a strict set that you abide by and you stick to these, because as soon as you stray away, you're going to start losing money and you're going to start taking risks which are completely unnecessary. So let's kick it off with rule number 1, and this is the one people find the absolute hardest to learn, and that is to cut your losses quickly. Cutting your losses quickly effectively means that you are selling a stock that's going south for you. It's not going well. You want to get out as quick as possible to prevent yourself from losing a lot of money. The best way to look at it is essentially it's better to lose $100 than to lose $1,000 or $10,000 or even more, because it is absolutely possible. And if you minimize your losses, therefore you allow your profits to increase through having greater returns on the stocks you invest in that are successful. In order to do this, you essentially need to set a point, whether that be a loss percentage or a drop to a certain value, where you decide, hey, I'm going to jump out, I'm going to sell the stock at this price. In doing so, you'll effectively be able to mitigate your losses to whatever percentage you want, so 5, 10%, and then you'll be able to reduce any potential losses that may occur if you didn't sell it. Now, when you're doing this, you might look at the stocks and say, hey, it's bounced after I've sold it. I could have actually made less of a loss or made money potentially. But if you look at it this way, then you're effectively going to start taking risks, and you're going to eventually take a loss that's so large that you lose a lot of your portfolio value. Cutting your losses quickly is really a psychological thing that you need to learn. It takes experience, and it's not nice to see your account go negative. It's not nice to take a loss, but the way to look at it is essentially you can use that as a potential tax benefit. You can look at it and say, hey, I could have lost a lot more money, and you just got to get out essentially. Rule number 2, and this is the absolute polar opposite, is to let your winners run. You want your successful stocks to make money. Yes, set a price where you'd say, okay, I'd be happy to sell now, but if it keeps going past that point, set a trailing stop loss in place so that you can effectively keep making money, but if things start to reverse in the other direction, you get out ASAP to secure your profits. One thing you should always remember is that the trend is your friend. So if something is going up, if your stocks are going up, if everything's going well, and you've hit the point where you're happy to sell, make money, yes, absolutely, you're entitled to do so. But then at the same time, if you can really see that this is going to continue rising in price and you're going to make more money off it, then let it keep making money for you. Just set that point where you say, okay, I'm going to get out now. Now, the next rule is going to sound a bit contradictory, but it's essentially don't be greedy. So as I said previously, let your winners run, yes, but you need to secure the profits. If the market's not going well, those little wins really do add up and they do count. And when you're in a bull market, yes, you can let your winners run, but at the same time, you want to make sure you're locking in those profits. You want to be selling shares and making money consistently. You don't want to be holding overnight if you don't know what's going to happen in the morning. One thing you really need to remember is that you can't lose if you consistently take profits. And when you combine this with something like cutting your losses quickly, you're minimizing your losses and maximizing your profits, but you're making consistent profits. You're letting your winners run, but at the same time, you're not being greedy. You know when to get out. You can see when clearly a pump has occurred and there's going to be a massive reversal in the price and the direction of the trend. Rule number 4 is don't trade emotionally, and this is a trap that a lot of beginner investors fall into. They'll fall in love with the story of the share even though they're supposed to be trading it. If you're investing long term, yeah, absolutely, learn as much as you can about the share, but when you're trading, you're trying to get those quick wins. You're trying to get in and out as quickly as possible. You don't want to be dwelling on potential gains you missed out on, and at the same time you don't want to then go into the negative and hold on for as long as you can because you fall in love with the story. You think the stock's going to reverse, but realistically it's not going to reverse at all, or it's going to take a few years to do so. It's easier to just take the hit now and get out, because then you can use the money that you've taken out elsewhere and continue to trade and make a profit. You need to make sure you're ignoring the noise. So you want to be focusing on the facts, you want to be focusing on the technical and the fundamental indicators at play. So as soon as you see things going south, get out, don't get attached. You don't want to fall into the trap of following someone on Twitter or someone on Hot Copper or one of those websites who's saying this is the next best stock in the world, you know? So get out, don't trade emotionally. And if you have jumped out of a stock, don't get attached to it still. You can follow it absolutely for potential opportunities, but don't get FOMO, don't get fear of missing out. Don't jump back in because everyone's hyped about the share, because often you'll be in a situation where there's a pump and dump, and if you get in at the top of that pump, you're going straight down to the bottom, you're losing money. It's inevitable. A good trade will always present itself to you. You don't need to go looking for it or forcing a trade. The fifth and one of the most fundamental rules before you enter a trade is to have an entry and exit strategy in place. You need to have those entry and exit points in place. Hey, I'm going to sell as soon as it hits this price because otherwise I'm going to start losing too much money and it could go south really quickly. And you also need that point where you go, okay, I'm comfortable to take a profit now, but obviously let it keep running with a trailing stop loss in place so that any potential gains can be gotten, but then you don't lose too much of the profit you've made. In order to do this, you really need to gain a bit of experience, try following different technical indicators that work for you. The fundamentals always help as well. These indicators will really help you dictate when you exit and when you enter. So for instance, if the stock drops below the 50-day moving average, you might want to jump out because that would be an indicator that the stock's had a bit of a change in trend and it's going down a bit more. Vice versa, you might want to say, hey, the 50-day moving average is crossing the 200-day moving average, which indicates a reversal in trend. We're going into a positive upswing of a trend, and that might be the point at which you say, okay, I'm going to buy into this stock. What you really need to realize early on is that when you stop being disciplined, when you don't have a strategy in place, that's when you start losing money. That's when you start taking really big risks that essentially will lead to many losses, and you're going to start reducing your profit. You need to choose those points at which you're going to enter, you're going to exit, so that you can lose as little and make as much money as possible. Thank you guys for watching another episode of my stock market basics. I hope my top 5 rules for stock market trading were of value to you. If they were, please leave me a like and subscribe for more content, and remember to leave a comment on what other sort of videos you'd like to see. What else would you like to learn, you know? So hope you all have a wonderful day and happy trading. See you later.